Hey, what's going on, everyone? Welcome to another video. Are you looking for a way to create weekly, monthly passive income through options? Do you have a small account and you're not able to buy 100 shares of Invesco, Tesla, Meta, etc.? Well, in today's video, I'll quickly walk through one amazing option strategy that you can utilize to create option income, collect passive income on small accounts, on large accounts. So stay tuned. It's going to be an awesome video. Really looking forward to it. And quick reminder, if you found value at the end of this video, I'd greatly appreciate it if you could like, subscribe, comment down below any stock you want me to cover. It really helps out the channel since it's a newer channel. As you may notice, I haven't uploaded a video in quite a while, so I'm getting back into the swing of things. Hope you enjoy it, and definitely stay tuned for more awesome information. So taking a look at the first stock ticker that I'm going to be covering today for this option strategy video is going to be Invesco QQQ. The option strategy that I'm going to be walking through is called a put credit spread. So this can definitely be utilized in today's market environment. It's optimal if the market environment is neutral, even bullish. So definitely take into consideration if you think the market is bearish, then you want to probably not do this strategy, or you could do it in a super conservative way that will still allow you to create option income. So what you're going to do, so this first example, I'm going to go into QQQ and walk you through what option strategies you can do and how to do it. So trade QQQ options, you're going to go here. And remember, this is in Robinhood. So this is an example I'm going to share with Robinhood. And remember, these are all examples. Don't copy these strike prices. Don't copy these spreads. Do your own research and determine what works best for you. So put credit spread. So let's take a look at how to set up a put credit spread. The first thing you're going to want to do is choose the expiration date that works best for you. A lot of people trade weekly options. A lot of people trade monthly options. There's pros and cons to both of them. In my opinion, monthly options work best. It allows time decay, so theta decay, to work in your favor when you're selling options. So like I mentioned, the first thing to do is choose the expiration date. So here we're going to go about a month out. So I'm going to go to middle of April, so about April 21st, so it's 39 days. And you can see the market share price here is 291, so we're going to go here. The next thing you're going to take a look at is up in the top left. So you want to make sure you're on put, and you're going to make sure you're on sell. And I'm going to bring back the share price. So this option strategy is going to be comprised of two legs. So you're going to be selling a put, and you're going to be buying a put. So effectively, you're kind of protecting yourself on the downside. So what's happening here is the first leg, you're going to be selling a put. In theory, if you're just selling a put, you're willing to put up the collateral to purchase 100 shares of this stock if you sell a put. So if I sold a put today for $290, I sold it for $944, I would collect $944 today, but your max loss is almost $28,000. So that's the amount of collateral required to purchase 100 shares of QQQ if you were to be assigned this stock. So personally, I like the put credit spread strategy because it allows you to earn option income with a much smaller account balance. So how are you going to do this? So I can use this as an example. So you're going to keep the 290. What you're going to do is you're going to select an option leg lower, and you're going to buy a put lower. So 5 points is kind of a typical spread to look at. So taking a look here, if I were to buy a 285 QQQ put, I'd be paying $7.70. So the market's live right now on Monday, March 13th. So, the prices are fluctuating a little bit. But you can see here, this is kind of what the P&L looks like. Quick reminder, so 290 put, you're selling, you collect 957, but then you're protecting yourself. You're buying an option a leg lower. So I'm buying it for 775, it's fluctuating. So kind of what's happening here is I'm going to collect a net credit of the delta between what I'm selling and what I'm buying. So if I were to do this today, I would get in my account $180, $185 today. And then this option over time, in theory, would go down in value, hopefully, and expire worthless. So effectively, the max loss is $300 because you're guaranteed the money you're getting today, but you are putting up that collateral in a sense of $500, the spread between the two strike prices. So you could look at it as putting up $500, or you could look at it as a max loss of $310, $300 roughly. So this is a pretty crazy return. I mean, I definitely say this a little bit riskier because QQQ is trading at 290 right now. So this means you're, extremely bearish. Sorry, this means you're extremely bullish on the market, and you're assuming QQQ will continue to increase over the next month, and the stock price will be above, this 290, 285 range in about a month. So I can take a look at a little bit more of a conservative price and strike point. So let's take another look here. So if I scroll down, it's trading at 291. Let's look at the 280. This is gonna be, super conservative. So let's sell the 280. So let's take a look here. The delta is still 0.3, so that's actually pretty high. Let's go a little bit lower. I'm gonna go all the way to 275. So looking at the 275 April 21st put. So if I were to sell this, so let's click on that, the 275, let's sell it. And then, like I said before, you're gonna wanna buy a leg lower. So it's interesting, the strike prices is in dollar increments here. So that's good for QQQ. I'm gonna go 5 points lower just to kind of keep that even 5-point spread. So here the delta is 0.19, implied volatility 32%, a little bit lower, but QQQ is kind of a more balanced option to play with. So, and then you're selling it to 275, you're going to be buying the 270. So buying the delta is 0.19. So let's buy this one. So now the spread is 98, 99, almost 100. So effectively what this is saying is the credit you'll receive is $100 today if you were to do a put credit spread on QQQ. You can kind of see the risk and reward profile. So effectively you'd collect $100 today. In my mind, you'd be putting up 500 of collateral. So in theory, that's a 20% return in 1 month. So it's pretty solid from a percentage ROI standpoint. And remember, if you're seeing this video in the future, you can still utilize the strategy. The returns and numbers may not be the same. But again, you also have to do your own research and determine what strike prices work and make sense for you and your position, whether the market's bullish, bearish, etc. Now I'm going to cover 2 more stocks that you can utilize the strategy on that I personally love. So the next one is going to be Meta. So Facebook, in other words, is going to be the next example. So as you can see, 3-month chart, continuing to be bullish, which is amazing, upward trend here. Facebook was definitely hit pretty hard over the past year, all the way to a low of around 88, but now it's, made its move back upwards. So let's take a look at some put credit spread examples. So the first thing I'm going to do is put and sell, so changing that. And then the next thing is the expiration date, like I mentioned before. So I'm going to go to April 21st, so 39 days out, a little bit over a month. And let's take a look at a couple strike prices. So this is going to be pretty conservative. I'm going to start with the 160. So the 160 strike price has a 47% implied volatility, a lot of volume and open interest, and a delta of 0.16. So let's sell this put. So in theory, I could sell a put if I'm willing to purchase 100 shares of Meta a month from now at $160. So, I would really only utilize selling puts on stocks you do want to purchase at a lower price, and you're fine with that. So if you just sell the put, you'd collect $2.67 per share. There's 100 shares in one contract, so you collect $266. But for the put credit spread, we're going to protect ourselves. We're going to buy an option at a leg lower than the 160. So in this example, let's buy the 155 strike. So as you can see here, the total credit is $69, about 70. Again, it's fluctuating because the market's open right now. This is definitely a much more conservative option. You collect $70, $75, you're putting up 500. So, that delta is about 15% return, roughly. So I think Meta is a great example to look at and to sell and buy put credit spreads on. So definitely take a look at Meta, look at the strike prices and the total credit that works for you. This is definitely a little bit more of a conservative example. You could probably go a little bit even more conservative. So let's just take a look at that and see what happens. So selling a put, before we did 160, let's go all the way to 140. So this is a 40-point drop from the current strike price. So if you go 140 and then you buy a put at 135, you would collect $19, about $20. So this is a less than 5% return if you were thinking about the $500 of collateral that you put. So this isn't a massive return by any means, but this is definitely very, very conservative. Given Meta's at 180, this strike price is 140, so that's a 40-point drop. So this is a delta only has a 5% chance of expiring in the money. Before jumping over to the third stock, just a quick reminder, if you could like and subscribe, if you found value in me going over these stocks, these options, it would greatly help out the channel and it would be much, much appreciated. Now, taking a look at Tesla, this is going to be the third stock that I cover for a put credit spread today. I assume most people know what Tesla is, so I'm not going to get into the details of that. Just want to quickly show kind of the chart over the past year. The stock has been making lower lows, as you can see here and over here, but it's worth noting kind of has had a movement upwards over the past couple of months after coming down slightly. So put credit spreads could be great in this situation. So I'm going to walk through those for Tesla. So similar to the other stocks, I'm going to change the expiration and I'm going to go to April 21st, about the third week in April, update the share price. Let's go to sell puts. So selling puts, and I'm going to go a little bit conservative. So I'm going to go with about a 150 Tesla put credit spread for the first leg. So, this is assuming Tesla hopefully won't go below 150 in the next month. So I'm going to click sell put there. So there you'll see if you sell a normal put, you would collect $595 today to potentially purchase Tesla at 150. So now we need to add one more leg to complete the put credit spread. So 150, let's go to 145. So I'm going to buy this put for $485. So you can see here now the credit is at $1.10. You can see here the premium is $110. You're putting up $500. That's a little bit over a 20% return again in 1 month. And this is assuming Tesla won't go below, 150 when it's trading at 172 today. This is a little bit conservative. You could probably be even more conservative and find better spreads between the two strike prices for a 5-point spread. So it's worth considering. I think Tesla's a great stock in the long term. My view is a long-term perspective. So this could be a great one to take a look at and a great option to utilize. So I hope you liked the video. Again, if you found value in it, definitely would appreciate it if you could like, subscribe, and again, comment down below if there's any specific stocks you want me to cover. I can go through a lot of different examples on a lot of different stocks. So just let me know. I hope you have a great week and I'll talk to you soon.